Amortization is the core of mortgage finance. In simple terms, it is bifurcation of equated monthly installment into interest and principal and working out the outstanding principal at the end of the month. It helps you to understand the repayment schedule of a loan. We will work out an amortization schedule manually for your understanding. Here is a case of a customer, Mr. Amritpal. He has availed a home loan of Rs 5 lakhs for tenure of 240 months at 9%. The EMI per lakh works out to Rs 4,500. Let us look at the status of amortization in the first month. The opening balance is Rs 5 lakh. EMI is 4,500 and ROI remains at 9%. Now, first we calculate the interest payable for the first month on the opening principal balance. We will use the simple interest formula. The interest works out to Rs 5 lakh multiplied by 1 month and multiplied by ROI of 9% divided by 12 as we need to calculate for 1 month. The interest works out to Rs 3,750. In the first month, the EMI paid is Rs 4,500. So, if we deduct 3,750 from EMI amount of Rs 4,500, we get the balance amount of Rs 750 adjusted against payment towards principal loan amount. Now, we need to find the principal outstanding at the end of the first month. So, we need to deduct Rs 750 paid as a principal component of EMI from the opening balance amount of Rs 5 lakhs. The principal outstanding works out to Rs 4,99,250. Remember, the principal outstanding at the end of the first month will be the opening balance in the second month. Similarly, we need to calculate the interest on the opening balance of second month. This works out to Rs 3,744 and the principal works out to Rs 756 and the principal outstanding works out to Rs 4,98,494. It is good to pause the session here. You should start learning to calculate the interest, principal and principal outstanding for each month from the third month to sixth month. Verify your answers with the figures displayed here. Remember to round off the figures to the highest digit. Now, you need to observe some interesting facts. If there is no change in ROI, you will observe that the principal amount as a component of EMI is going up every month. And the interest amount is going down every month. And the principal outstanding at the end of the month is also reducing. You can also note that this amortization process is called monthly reducing as interest is being calculated on the reduced outstanding balance of the previous month. You should also note some more interesting facts. If you calculate the principal component of EMI as a percentage of EMI, it works out to only 16.66% in the first month. The balance amount of 83.34% is paid towards the interest on the loan amount. Further, if you calculate the principal component of EMI of first month as a percentage of opening principal balance, it works out to mere 0.15%. In fact, in the initial years of the loan tenure, the maximum percentage of EMI goes towards interest and a minuscule percentage goes towards principal. In this example, you can observe that till the sixth month, the EMI paid is getting perfectly bifurcated and there is no shortfall towards payment of interest or principal. This amortization worked out here is also referred as positive amortization. Let us now create a scenario where the rate of interest changes from 9% to 15% at the end of sixth month, but the EMI paid by the customer remains constant. In this situation, the amortization from the seventh month will change. Let us look at it. So, in the seventh month, the interest will be calculated on the principal opening balance of the month. In this case, the interest works out to Rs 6,193. Now, this is going to be a problem as the EMI paid is less than interest due. In such a situation, a mortgage finance institution will apportion the entire EMI amount of Rs 4,500 paid in the 7th month towards interest. Even after payment of the amount, the deficit interest is Rs 1,693. So, ideally, deficit amount will get added to the opening principal balance or closing principal balance of 6th month. You can observe that instead of principal outstanding going down, the principal amount goes up by Rs 1,693 to Rs 4,97,107. The amortization worked out in the 7th month is also referred as negative amortization, as the EMI paid is not even sufficient to repay the interest. As a result of that, instead of principal amount going down, the principal amount starts going up as the deficit interest is getting added back to the principal outstanding. As a practice, the mortgage finance institution normally will not go for negative amortization whenever there is increase in rate of interest. The first choice is to inform the customer and increase the tenure of the loan so that amortization remains positive. The second choice is to increase the monthly EMI. In case the customer wishes, he can always come and prepay part of the loan amount so that there is minimum disruption in payment of the EMI amount and the tenure of the loan. Now let us look at a scenario where a customer wishes to prepay part of the loan amount to reduce their liability. Please note that there is no change in rate of interest. In this case, the customer wants to prepay Rs 1 lakh in the 6th month. As a practice, the mortgage financial institution will work out the outstanding principal at the end of the month and prepay the amount and work out new principal outstanding after prepayment. In this case, you can see that the prepayment amount of Rs 1 lakh is getting deducted from principal outstanding of Rs 4,95,415 to arrive at the new principal outstanding of Rs 3,95,415. In the 7th month, the interest will be charged on the opening balance of Rs 3,95,415. As a result of the prepayment, the original tenure of the loan has come down from 240 to 150 months. Here, you can see the revised amortization from 7th month to 150th month. Had the customer continued for a tenure of 240 months, the total amount paid as EMI works out to Rs 10,80,000, and now, after prepayment, the total amount paid would be Rs 7,75,000. The total savings works out to Rs 3,05,000. Let us understand the different options that one can opt on prepayment. The options are: 1. Either can reduce EMI with same tenure, or 2. Have same EMI and reduce tenure, or 3. Increase EMI with option of reducing the tenure. Let me now pose an interesting question, having understood amortization, the savings made on prepayment and the various options available on prepayment. The first question from a customer perspective is whether the customer should prepay in the initial stages of loan repayment cycle, or at middle, or at the end. Well, it is always beneficial for the customer to prepay in the initial stages, as we saw that initially a large component of EMI goes towards interest and a smaller component towards principal. However, from the mortgage finance institution perspective, it is a loss of income if the regular borrower prepays their loans in the initial phase of loan tenure.